Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please look at the share screen and disclaimer and be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you are searching for investment advice, please reach out to a licensed professional. This show is for informational purposes only concerning Market Chameleon tools and products. With that, D, let's roll.
Yep. Good morning, everyone. And 1 second here. Let me share my screen. And as I'm sharing my screen, quick note to anybody joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keep an eye on it, and he'll let me know, read it back to me. And to give you a couple minutes to type those questions in, we'll start out taking a look at our pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we'll move on to our questions. So pre-market report here. Up top, we get this calendar view. And what this does is show summary statistics of what happened in the pre-market hours on these historical dates. The idea there is to compare today's pre-market trading activity with the most recent history. This allows you to spot perhaps something unusual or a trend. Let's start out with today's May 21st activity. And here we see 392 stocks are trading higher in the pre-market, 451 stocks trading lower. We have 246 million shares trading on up volume, 320 million shares trading on down volume. If we convert that volume to dollar value, we have $1.6 billion worth of stock trading higher, $1.7 billion worth of stock trading lower. So this points to a mixed bag. It doesn't look like anything that's too conclusive. We're overwhelmingly bullish or bearish in the pre-market hours. It seems a little bit balanced there. Let's look at it from a couple more perspectives, and then we'll go on to our questions. And I'm going to slide down. And now we get this more granular view of what's going on in the pre-market hours. We have our most active stocks, our biggest percentage gainers and biggest percentage decliners. Coming down here, and I see 57 stocks made it onto our biggest percentage gainers list, 60 on our biggest decliners list. So that also is pretty balanced. Nothing pointing overwhelmingly to either direction. Now, to make it onto this list, we do have thresholds in place because stocks in a pre-market can trade with low volume, low liquidity. And if it meets our thresholds, it can make it onto this list, and it includes small cap stocks, it includes ETFs, it could be a leveraged product, could be an inverse ETF, closed-end fund, and so forth. So to narrow down this list further, we could use the filters above. If you have a watch list and you created a watch list with a group of stocks that you track, you can filter this report by your watch list. We're going to use this filter in ETF in our example. So I'm going to click on it. You get this drop-down menu with different ETFs. We're going to select the first one, SPY. And when you do that, you can see that the list below got filtered by stocks that are holdings in the SPY ETF. So what we did was narrow down the group of stocks we're analyzing to S&P 500 companies. SPY is the S&P 500 ETF. Here, very similar, 6 stocks made it onto our percentage gainers list, 4 on the decliners. Again, nothing here points to any type of lean in the pre-market hours. They could say it's, bullish or bearish. Looks like a mixed bag so far. We gave it a couple minutes, Will. So if you have a question, I'll take it down.
Nothing's popped up yet, D.
Okay. And there was a question maybe left over from yesterday. Don't remember if one at the end of the day, if you wanted to read it back.
Yeah, there was a question from a new user. Let me just go check my email that I sent over to you.
Okay. So while we're waiting for that, let me navigate maybe to SPY, see if that would be a candidate to look at.
Yeah, actually, before we get started, let me just share my screen. I got it up. All right, just everyone take a quick look at the disclaimer one more time. All right, D, you want to share your screen again?
Yep.
All right. We had a question from Tiffany. Another question. If I own a stock and I'm interested in selling a call against my stock, my preference is to have a higher probability of it expiring out of the money. Is there a place in the tool to find strike and expiration? Is what she's asking.
Okay. All right. I'm trying to uh think about what the question itself. So let's say you own a stock like Apple, right? So let's say you own a stock and you're looking at the options chain. And I think the question is, if I'm looking at this options chain and I wanna sell an option to do a buy, right? And I think that the person's trying to avoid having the stock called away. All right.
Correct. That's what it looks like to me too.
Okay. So I mean it's a good question because sometimes I get similar questions and the question itself has a preface or an assumption that there's something where we could calculate and we know exactly what will happen in the future, right? Like that that if you do this option, it will not get called away. It won't be in the money, it won't get called away, and so forth. And I have different types of questions similar, but the end goal is, well, how do I know exactly where something will be? And before we kind of go into this exercise, it's important to understand there's certain things that we could know exact, right? Like I could know exactly what the price of Apple is at that moment, if I'm looking at the quote. Maybe I know exactly what the dividend will be if the stock or the company announced that they're going to pay 50-cent dividend on X date. Well, I know that's that in the future, I know exactly what the dividend will be, what the X date will be, what the pay date will be. So certain things, that information we know exactly what that is. But then there are other things that we don't know. We don't know exactly where Apple stock will be or where the option will be, or which strikes at expiration will expire worthless, which ones will be in the money. Those are things we don't know. That's where the risk premium comes in. So anything that if we know the exact answer, there's not much risk premium or value in it because everybody knows the answer to that. All right. So once everybody knows the answer to the question, then there's no risk premium in there. There's no extra value for doing anything. It is what it is. And everybody knows. It's where we start to go into the unknown, right? That's where we see the risk premium and the opportunity to make potential profits there. So having said that, we don't know exactly where these options will end up. So we don't know, which option to sell, to get that desired outcome. But then what do we do? How do we handle that situation? And a lot of people haven't dealt with these circumstances, because if you, for example, work for somebody, well, you know exactly your salary, the paycheck you're going to get. If you put money into a CD in a bank, you know exactly the interest rate you're going to get. But here we're dealing with uncertainties. So how do we deal with that? How do we start making projections? Because that's what you're going to end up having to do. And to give you an analogy, maybe something that expires, right? We're dealing with options, they expire. There's an expiration date. And let's say you were, you had a grocery store, right? You have a grocery store, and you sell apples and oranges and milk and stuff. But all these things have an expiration. Then they're not going to live there forever. An apple is going to spoil, milk's going to spoil, banana. So now you're dealing with inventory that you're holding, and you have to figure out how to successfully manage that grocery store to stay profitable in business. Because if you don't, you're going to go out of business. So if you buy an apple, and you're going to buy it at one price, and if you can't sell it by expiration, goes to zero, or if you have to keep reducing it below where you bought it, you're going to lose money and you're going to go out of business. So how do you stay in business given those circumstances? And how do you price the apple? Right? Well, and here we're dealing with uncertainty too, because you don't know exactly when a customer is going to come in, and at the exact moment he needs an apple, he's going to buy that apple, and the exact price he's going to pay for it, the highest price. You don't know that ahead of time. But without knowing it, you'll have to make some kind of a projection. Right? That's how you run the store. Nobody knows exactly when the customer will come in and buy this apple, buy this milk, and that you're going to exactly, buy this amount of inventory, and that you're not going to have any spoiled apples. You're not going to have to reduce anything, and they're all going to be sold on this date for exactly this price and premium. We don't know that. But grocery stores are still in business, right? They figured out a way, a formula, a model to manage that inventory, that risk premium, that inventory, and smooth out the profits and losses over time. But to do that, they have to then have some kind of a model projection. Meaning, if you're going to, if you buy apples, you're not going to be able to sell an apple for $1 million, right? What you need to do is start to create ranges. What are the ranges that I could potentially sell these apples? My low range, high range, my average, right? Standard deviations. That's what you have to start building, right? Potential ranges that these are going to end up. Potential ranges of how many I could sell. How long is it going to take me to sell it? Right? We know because it would be unrealistic to think I'm going to buy these apples and I'm going to sell them for $1 million. Right? And it's unrealistic to buy apples and then offer them for a penny. Right? And it's unrealistic to think, well, I'm going to fill my whole store with apples, and that people are going to come in and just buy apples. So that's what we have to start dealing with to make projections, potential ranges and averages and so forth. And this is kind of then what we start out. That's our starting point, right? That's where we were like, okay, if Apple right now is 191, right? Let's just come out to June 14th. So the question is, if I'm looking at strikes, I'm looking at premiums, where do I sell? Well, First is, well, where do I think, Apple stock price could end up in, 25 days, trading days? I don't know exactly, where it's going to be. There's nobody knows, but, I could start building myself a picture. It's not likely to be at a penny, right? It's not likely to be at 2 pennies or $1, $2. It's not likely to be at $1 million. But let's start figuring out where can it possibly end up. First of all, high, low averages. That's what we want to do. So let's just start building that picture. So we could, but how do we do that? Right. Well, one is we could look at historical patterns, right? So that could be our starting point, the historical patterns. So here's Apple. This is going to give us historical patterns based on, these days of expiration. So how much can it move in 18 trading days? Okay, so this way we could look at strikes, potential strikes that it could hit. And it'll also include a seasonality, because sometimes things move differently different times of the year. Okay, that just happened. You might sell more pumpkins at a certain time of year, or more turkeys at certain holidays, or so you guys get the picture. So let's take a look at that first. And if we drop that down, now we're kind of getting a better picture of like, well, how did it tend to move? Like what kind of ranges are we talking about here? Is it 50%, 20%, 10%? What kind of ranges are we talking about? So there are two summary stats here for us. And, we could go and use our calculator to expand it. And one of them is looking at a seasonality. So this is looking from May 20th to June 14th, which will cover the calendar days between now and this expiration. So it's going to go back 10 years and see what, you could look at it here. What tended to happen during that period. So you could see here 67% of the time Apple was higher, 33% it was lower. On average, if we took the average of all the returns, it was 1.9%, which it tended to have a more positive skew, tended to be up more than down. And on average, it drifted higher. Well, then we could also separate it and say, well, when it was higher, right? Because those are taking the averages of higher and lower. When it was higher, what was the average move to the upside? When it was lower, what was the average move to the downside? So we could kind of get an idea of our potential gains versus potential losses. Like, well, if it's up, right, what does it tend to go up? Well, on average, it goes up 4.6%. What about down? Well, on the downside, it was down 3.5%. So you could see that it was skewed towards the higher side. All right. Remember, not only are we trying to build potential profits, but what are potential losses here? What if we're wrong? What if the stock market's down or Apple's down? What are we looking at here? What about the extremes? What was in our data range, what was the best and worst, highest and lowest? So here we have a picture. Highest move so far to the upside was 7.8% on a seasonal, and down 5.2%. Okay. So that's a seasonality. What about just any 18-day period? So there's 18 trading days left, right? This is what this is saying over here. 18 trading days, 25 calendar days. So over an 18-day trading period, right? Because weekends, Apple doesn't trade and so forth. So days that it trade, how does that look over 18 days? Because over an 18-day period, there is much greater room for the stock to move than in like 1 second, right? It's not going to, in 1 second or 1 minute, you're not going to see the same type of moves that we will see over 18 trading days. So what are we looking at if it was over an 18-day trading period? Well, this also indicates that it the frequency of the up moves tended to exceed the frequency of the down moves, 60% to 40%. The average of the returns, if we average the losses and the gains, was 1.8%, also indicating a skew, a bias towards the upside. What about just the average of all the up moves, right? So now we're looking at 18-day periods, not seasonal. So this is looking at 4 years of data. So here, the average of all the up moves was 7.1%. You can see here greater than the seasonal, 7.1%. Average of all the down moves, 6.1%. Okay. The best move, the highest, 19.6, worst, 13.3. So we're getting some ideas here of potential outcomes. You know, if historical data is any guidance, tended to drift higher. The ranges, you know, could see 19%, you know, to the upside, 13% to the, so it could have potentials, you know, a big move here, almost 20%. You know, on the, if it moves up, tended to on average move of 7.1%, down 6%. So now we have these different ranges to look at, you know, in the back of our mind. Here's a 10% move, you know, here's a 7%. This strike is up 7%, and then you could take into consideration that premium. So here, you know, when you're doing these, you could see, what do I have potentially to gain if it is up 7%? What do I have potentially to lose if it's down 6%? If I use the averages as my initial, you know, assessment, you could do it against your assessment against the more extreme moves. You know, again, we don't know for sure, but we're using that historical data to create ourselves potential outcomes. But it's not just historical data that we should be looking at. There are other factors that could come into play that are not reflected in historical data, right? And upcoming events, unusual volatility, maybe something is going on that hasn't even in history happened before, like when we had COVID, where you can't even use, you know, data or ranges because it just there's nothing to analyze. It hasn't happened before, you know. So those are things to consider. So right now I'm looking at June 14th and I'm hovering over and there's an event. So now we know on between June 10th and June 14th, Apple is going to hold a worldwide developers conference. Well, this option is going to cover that event. And then we could go back and see if that happened before, right? We don't have enough time, but we could go back and see, well, you know, maybe that's happened in history, worldwide events. Did that create more volatility? Did that create bigger stock moves? What did the stock tend to do? Was it tend to react more positively or negatively to these types of events? Maybe we could find out more information and details about this upcoming event. Are they going to, you know, expected to release something, you know, that might be a blockbuster hit? Who knows? You know, but those are other things then we have to start taking into consideration into our model building. right? So over the long term, we're not going to get them all right, but we're going to smooth it out, just like a grocery store where our averages, right? That on average, our our profits would exceed our losses, right? So on average, we're positive. So these are all starting points that you would have to start taking into consideration. And then once you do that pre-trade, right? Once we do that pre-trade, how do you manage it post-trade? How do you manage if circumstances change? What do you do if the stock is going up? Do you roll? Do you reassess? What is the plan going forward? If it goes down, what do you do? Do you take off risk? Do you try to trade it delta neutral? Do you try to offset some of your risks? Using other options. So there are lots of different things, to start considering when you're doing this. Pre-trade and post-trade risk management. So post-trade risk management is a huge part of the success because, the options themselves, trading options, it requires, whenever you're trading, it requires post-trade management, risk management, and you can't do without it, right? It's not like passive trading is not the same thing as passive investments, like where you just buy a stock, an ETF, or invest in a mutual fund and you wait, 5 years passively. Trading is not like that. Trading is more active. It's managing a inventory of risk. So we're right up at 9:30. Well, I think I'll maybe stop it right there.
Great job, D. Listen, we did have a question from Rob. Maybe we can look at it tomorrow. I guess NVIDIA's earnings are coming tomorrow after the closed. He wanted to do a walkthrough, look at NVIDIA earnings tomorrow. So maybe we can do that tomorrow. Perfect. Okay. Thanks, D.
Sounds good. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day.